And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025. Good evening. Welcome to The Money Show. I'm Stephen Grootes, 9 minutes after 6. Lots coming up in the next little while. I was staggered to see this story MoneyWeb. I thought that wrote it up particularly well. That seems to suggest that the terminal operator agreements in Durban, these are at the Island View Precinct, they're owned by Transnet, but basically, if you're able to use that terminal as an oil company, you get to be a part of the 70% of the fuel which comes into the country. It's a huge amount. It's basically the Transport Minister Barbara Creecy has effectively given the companies that are already there another 25 years. So their contracts get rolled over for a 25-year period. I mean, work out how old you'll be. 2050 is when they'll expire. I must say, on the face of it, and I haven't heard her version, I haven't heard Transnet's version either. We are hoping they'll speak to us tomorrow. But on the face of it, this seems to go against what government wants to do, which is to broaden the economy, transform the economy. This seems to go in a completely different direction. We'll get a bit more about it in the next couple of moments. We'll hear from Andrew Pike, the head of Bowmans Ports, Transport and Logistics. We'll hear from Warwick Lord as well, the chair of the Multi-Modal Inland Port Association. Lots of conversations around the very high gold price, whether that indicates that maybe we're near some kind of bubble or some kind of crash in markets. Lots of people using the word correction at the moment. Dion Grootes from Credo, he'll talk to you about that in about 10 minutes from now. The Food Insecurity Index, it's a fascinating piece of work, and it really tells you what's going on with how much food we have. Still around a quarter of our children are stunted. They're not getting enough food. And that number was going down until the pandemic and shot up again. And it tells you everything you need to know about the problems in our society, that 1/4 of our children do not get enough food. It's a staggering number. We'll talk about that tonight as well. And then the Government Employee Pension Fund, they've updated their actuarial factors. And that means that early withdrawal estimates have been cut by 15%. A few questions about that. They've agreed to talk to you about it. Looking forward to hearing from you tonight as well on 011 883 0702 021 446 0567 and voice notes 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
One of those big cabinet statements that has all sorts of boards and names in it coming out today, in confirmation that Mteto Nyati is going to stay on as chair of Eskom. And it's one of those moments, there's an old English phrase, if it ain't broke, don't fix it. In other words, if it's working, don't meddle. I suppose in the case of Eskom, you would say, if it's being fixed, don't break it. So I was very pleased to see Mteto Nyati remains. There are some new board members, but by and large, a lot of the expertise, a lot of the people are staying. Obviously, Dan Marakane, the CEO, has done so much to end load shedding. He stays. He's not a part of this announcement. But just a reflection on how much has changed around Eskom. There would have been a time, you go back to the beginning of 2018, for example, when this would have been the biggest political story there was. Who's on the Eskom board and why are they there? And in fact, it was changes to the Eskom board that really showed you that the sort of Zuma faction in the ANC had lost power and the Ramaphosa faction were taking over. Today, the announcement about the Eskom board is almost sort of a whimper. And I think that tells you more than anything how much progress has been made. You bump into someone who works at Eskom, from Mteto Nyati down, maybe the CEO, Dan Marakane. Take them aside and give them a jolly good handshake. They've deserved it. They deserve it. 13 minutes after 6.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
An important story, I thought, in MoneyWeb this morning, suggesting there's now some opposition to a decision by the Transport Minister Barbara Creecy to renew contracts with international oil companies that allows them to operate at the Transnet Island View Precinct in Durban. The contracts have been renewed for 25 years. So these companies, as I understand it, will be able to use the port to handle the majority of our fuel imports. No tender process before this decision. No other companies able to tender. The current contracts just roll over for another 25 years. Warwick Lord is the chair of the Multi-Modal Inland Port Association. Warren, good evening. These operators have had the benefit of a long contract there already. Now they get another 25 years. How do you view this decision?
Well, so Stephen, evening to you and your listeners. Well, with every news breaking, there's two sides to every story, and there's positives and both negatives. So, on the positive front, this has been going on a month-to-month lease basis for the last decade or so, which means that no capital investment could really be put in. There was no certainty, and there wasn't a sort of knowledgeable decision-making process you could take with regards to investing further. And so the situation that was there was definitely untenable. And so giving security of tenure does then allow for capital investment and operations to really kick in and go well. On the negative side, as we start looking to open up the supply chain to more private sector players, and you obviously know about the ICTSI news, and Andrew Pike, I understand, will be on a bit later, and congratulations to him and his team, that as we're looking to privatize and get in more new players into the various sectors of the public space, and specifically into the transport infrastructure, to now just roll over these awards into the existing incumbents sort of feels like it's going in a little bit in a different direction to the rest of the supply chain discussion. So those are my initial thoughts.
I mean, government says all the time it wants to transform the economy. It wants to open it up to other operators. We know our economy is over-concentrated. This does seem to go against that philosophy.
It does, and if you look back at the reason why this first originally got established in this way, it was because of the fuel producers needed tank farms and etc. to hold their product in. And now that we no longer have refineries busy refining and the sort of tied interest required to tank farms, now that that's been replaced, it does sort of seem like we missed a chance. We missed an opportunity to really bring in some new players and basically come up with a slightly different way of doing it instead of just rolling over the leases for another 25 years.
So if those refineries are no longer there, how important is this terminal now to the area around Durban? I mean, I presume it's a vital piece of infrastructure, and that makes this an important contract?
It's a very important contract, and not just from the people sort of around and in the area, because this is a pinch point in the fuel supply chain. And so if you have sort of control of these tank farms and the ability to get the fuel in and out of the country, you then control a very large and very strategic asset. And without the country having its own direct involvement in it in some way, shape or form, I fear that, being at the total behest of private sector comes with risks at times. I'm very much an advocate for private sector involvement, but at the same time, government needs to look after the strategic assets, and I believe fuel and fuel shortage is definitely one of those.
Warwick Lord, thanks very much indeed. Chair of the Multi-Modal Inland Port Association. 16 minutes after 6 on The Money Show. Andrew Pike is the head of Bowmans, Ports, Transport and Logistics. Andrew, good evening. I was a little surprised to see that one person, the minister in this case, can make a decision that will last for 25 years with no open tender at all. In other words, she can make a decision that clearly has long-term consequences, and just do it on her own for such a long period. Is she on strong legal ground?
Evening, Stephen. Yeah, it's an interesting question. So the minister would have issued a directive under Section 79 of the National Ports Act, and that gives her the power to direct Transnet Port Authority, that is, to do anything which it would otherwise be empowered to do under the National Ports Act, when it's in the national strategic or economic interests. So it's a directive which is used from time to time, not always necessarily used in the right fashion. For instance, you'll recall the car power ships controversy. It was used at that time by the then minister to give car power ships access to the ports. And as we know, that failed on other grounds. But be that as it may, I've always held the view that the minister can only use that particular section of the Act in order to tell Transnet to do stuff which they're already empowered to do. Now, normally I would expect a 25-year lease or concession to go out under Section 56 of the Act, and that requires Transnet to put it out to tender. So I don't believe Section 79 allows the minister to tell Transnet that they don't have to go out to tender. So, without having seen the directive itself and without having looked at Transnet's own procurement rules on whether it may or may not extend these leases for 25 years, it's a bit difficult to say. But I have to agree that I'm a bit surprised to see it working in that way.
I mean, what you're suggesting is that there might be some grounds for a challenge. And if you consider, I accept that a 25-year contract might be important because of the level of investment. So that would not be the ground. The ground would surely be that government says it wants to transform the economy, and here it's doing the complete opposite. It's re-entrenching previous players for a long period of time.
Well, yes, but there is a softener to this. And that is, my understanding is that as part of these leases or part of the deal, the Central Energy Fund, which has, I think, as you know, taken over the Saperiff refinery, has to be granted a certain amount of the capacity under each of those leases. And that capacity will ramp up over the next 20 years or so to eventually 30%. And the CEF will then be an aggregator for new entrants and will ensure that they then get some of that capacity through their agency. So the minister, I think, is trying to balance the issue of security of supply against or with transformation. And the transformation side of it is that there will be up to 30% of that capacity guaranteed for new investors. But, you know, the bottom line is that the incumbents remain entrenched, and you can't get away from that.
Andrew Pike, really appreciate that. Thank you. The head of Bowmans Ports, Transport and Logistics.
702. Stephen is on X.
At Stephen Grootes.
Over the last few weeks, there's been a few more voices coming out and using words like bubble or correction in relation to U.S. markets. The Economist publishing a piece from a former IMF chief economist, Geeta Gopinath, suggesting any crash now would be far worse than what we saw during the dot-com crash, for example. Other people like the JP Morgan CEO, Jamie Dimon, speaking about a possible correction. The Bank of England said 2 weeks ago any change in sentiment about AI would have a big impact of markets. And of course, you can see from the gold price that there is clearly some concern in some quarters. Dion Goos is the Chief Investment Officer at Credo. Dion, good evening. How worried do you think we should be about a possible market correction?
Stephen, I think when you participate in the markets, you're really always worried that the next correction is around the corner. But to bring in the context of specifically, you know, the phase of the market that we're in with all this AI activity being in the news and the kind of pronouncements that you quote there, I think my response would be that if there's a bubble in the market, we're possibly at the early stages of such a bubble and not the late stages. And the reason that I phrase it like that is really two sides to the story. There's the pessimistic side which acknowledges that there's a number of companies, mostly smaller companies, that are perhaps overhyped and overpriced. But then on the other side of the coin, you've got the large hyperscalers which are not trading cheaply, but they're certainly not trading at bubble levels. And these companies make up a much larger percentage of the index, and therefore I think the risk of them, you know, falling at tremendous rates, which will amount to popping some sort of bubble, I just don't see that in the short term. I may be wrong, of course, but I just think that the risk lies in a relatively small number of smaller players, not in the few dominant players that you know what the names are, the so-called magnificent seven.
I mean, the strange thing, obviously, is that gold is normally the safe haven asset. It's now $4,200, in fact, way over that this evening. And at the same time, there's a huge amount of money in US stocks because investors believe they'll be more valuable in the future than they are now. So you've got one group of people. I mean, I realize that, you know, one person can be doing both things, but there's a lot of money in the safest of havens, and there's a lot of money going into stocks that people think will increase in value. And it would seem on one level that both of those things can't be right at the same time.
Well, I think you say that both can't be right at the same time because historically they haven't really moved together. But I think the reason why one can perhaps explain why they're moving together at this time is because of what we're seeing in central banks around the world, is because of country deficits, the fact that most major countries, and let's start with the US, it's the biggest gorilla in the room, and therefore it moves markets around the world because the government debt keeps on escalating. Over the long term, there's really only one way that the US can get out of its debt problem, and that is to inflate it away. And if that's going to be the case, you don't want to be in cash, you don't want to be in government bonds, you want to be in real assets. And real assets are different things for different people. If you like gold, it will be gold. If you like equities like I do, it will be buying stakes in the world's best companies. That's also a real asset. For some people, it will be farmland. For some adventurous people, it will be crypto. And therefore, you can actually see a scenario, I think, where most real assets meet together in a world where government debt is being inflated away and money is being debased.
There's several elements to it all. I mean, there's the idea that money invested in artificial intelligence will be worth more in the future than it is now, and that's probably true. There's also the concentration or the over-concentration in just 7 big stocks in the US, the magnificent 7 tech stocks. Does that concentration worry you? As you say, you're more worried about the smaller players, but it's still a huge proportion of capital in just 7 companies.
I guess it does worry one somewhat, because always, any investor knows that diversification is your friend, and that your diversification opportunities are relatively limited. That's clearly not ideal. But in these hyperscalers, we are talking about arguably the best companies that the world has ever seen, that have been able to build fantastically huge businesses that are hugely profitable, growing revenues in a relatively capital-light way, and generating profits that allow them to pay down debt, to still pay dividends, buy back shares, and frankly, this is the phase of the market we're in now. For the first time, maybe ever, having additional money that they need to spend on capex. So these are very profitable companies. If you compare this to the dot-com era, for example, I think is flawed. At the dot-com era, a lot of the biggest companies in the world didn't make a penny of profit, and yet they were trading at silly multiples of revenue, and they were never going to make a profit. And then in mind also that when the dot-com bubble burst, that was at the same time that the Fed had started raising rates. We're in an easing cycle now. So yes, I would have preferred if there were more options, but it's not like I don't sleep at all at night, given the reality of how the market is comprised.
Dion Groos, thanks so much. Chief Investment Officer at Credo.
The Money Show.
The markets.
26 minutes after 6, Rudy van der Merwe's Portfolio Manager at Advice Works. Rudy, good evening. Interesting deal. The Premier Food Group essentially buying the Rhodes Food Group, and I presume the Rhodes Food Group, a brand you'll see on most supermarket shelves, will slowly fall away as a brand.
Evening, Stephen. It does look like a very attractive deal. I don't know if the brand will entirely fall away. Now, obviously, they've got very, very some customers that are very loyal to the brand, and I suspect Premier might hang on to a lot of those underlying brands. There's quite a lot of them that aren't particularly sort of Rhodes Food Group. Things like Bisto, for example, and Bull Brand and the like. So a lot of those brands are quite strong and have a loyal following. It does seem to be, from the face of it, a very attractive transaction. I think there's very little to no overlap of product, although they probably have a lot of customers in common. And it seems like Premier's getting this business on a forward PE of about 9, whereas Premier probably trades on a forward PE of about 14. So it looks likely that it'll be earnings accretive for Premier, and one would think that there's some synergistic costs that they can cut out of this business. So it does look attractive. They're paying effectively in shares, so 1 Premier share for every 7 Rhodes Foods Groups, which values Rhodes at about 22 Rand a share. It looks like this is going to be good for Premier.
Is it a way for Premier to grow in a difficult economy? You basically find a company that's in your business, but you don't compete with or overlap with, and you sort of buy them?
Absolutely. Their choice is to either try and grow products that are complementary to their existing suite, by investing a lot of capital and spending a long time trying to build loyalty and distribution and production capabilities and the like. Or alternatively, you can go and buy a competitor, or I suppose not a direct competitor, but somebody else in the industry who has an existing business and customer loyalty and production and logistics facilities, where you think you can add value through either distribution or just cutting out costs that you both have in common. And very often that is a sensible way to do it. And then it looks, in this case, like Premier's found a good fit.
Results and update from PSG today seemed on the face of it to be quite a strong update.
Yes, it does look like a strong set of results. They've sort of quietly in the background over the last number of years built a very substantial and successful business, and it seems like they continue to do very well. It was half-year results, but headline earnings up 21% to 58 cents a share. They managed to increase assets under management by 19%. Seemingly within the wealth business grew about 18%, and the asset management business grew assets under management by 21%. Gross written premiums in the insurance side up by 6% Still very attractive levels of return on equity in the north of 28% at the moment. It looks like a very, very attractive set of results in a difficult economic circumstance, and also quite encouraging to see they're still spending quite aggressively on technology to keep their systems relevant at the moment. I think there are a lot of other businesses in the industry that can take a sort of a lead from them in that space.
Wouldn't be a market update at this time during this period in human history without a reference to the gold price, $4,200. In fact, wouldn't be surprised if it's $4,300 already.
Yeah, very strong still. I mean, we've seen obviously an acceleration of late in precious metals prices, and our market on almost any given day at the moment, the commodities sector, or certainly the precious metal sector, is dominating the sort of headlines. Our market largely was marginally positive, but resources were up over 5%. So, and then in the top few companies that accelerated on the day, sort of the platinum and gold miners feature very prominently. Sibanye was up over 8%, Harmony over 6%, Northern over 6%, Goldfields 7.5%. So really strong moves. Obviously, they're big beneficiaries of the uncertainty in the world just at the moment, which stems from a host of places. There's a lot of uncertainty about geopolitics for a start, but also uncertainty about how economic policy rolls from here and what exactly the impact of uncertain policy is. The US government shutdown, I think, has given impetus to this sort of move in commodity prices of late. And then, as your earlier commentator, Dion Host, was mentioning, sovereign debt is a massive concern, and it's not only in the US. The UK has issues. The bulk of Europe has issues. The East has enormous debt issues. So it's not only the US that's going to look to potentially inflate this away. And if they inflate this away, which currencies are safe? And possibly none of them are. And I think that's what's pushed the gold price, and then platinum has sort of caught on from that, and seems to have a lot more legs to go. Traditionally, it has traded higher than the gold price, and I think if that's where it's headed, there's a lot further upside to come.
Rudy van der Merwe, thanks so much. Portfolio Manager at AdviceWorks. Just after 6:30.
WhatsApp Stephen
on 072
702
1702.
Well, 20 minutes to 7. You heard that conversation around the tender at the Transnet terminal. It's all around oil capacity and the decision by, it seems, the Transport Minister. We hope to hear from her tomorrow, but voice notes coming through on that tonight.
Hi there, Stephen. I think the extension of those oil contracts for another 25 years will only really become relevant when we understand who owns the companies who have been awarded those extensions. I'm willing to bet there's some fairly serious political players that own those businesses. Cheers. Peter.
Peter, thank you. Look, I mean, strange things have happened in the past. And in this case, it is major oil companies. There are agents, of course, involved, and sometimes it's not just them. But remember that strange story when we sold, I think Carol Payton broke that story, when we basically sold our oil reserves, our strategic fuel stocks, when oil was at record lows. I mean, that was an astonishing story during the state capture era. 19 minutes now to 7.
702. Stephen is on X.
At Stephen Grootes.
Quarter to 7 the time, 011 883 0702 021 446 0567. A story I'm sure has affected you. The fact that since the end of the pandemic, food price inflation, food prices had just rocketed several years ago. Only in the last 10 months that food price inflation has really come down significantly. That's fed into inflation overall, of course. The latest edition of the ShopRite Food Security Index shows food security in South Africa has improved slightly over the last year. Professor Dieter von Funtel is a professor of economics at Stellenbosch University. Dieter, good evening. Can we link lower food price inflation to this slight improvement in food security in most of the country?
Yes, thank you, Stephen. So when food inflation declines a bit, it does create more stability for households, and it allows them to plan their budgets better so that they can start thinking about better food choices and also be able to reduce hunger within their households. So food prices are a very important factor of food security, and we see it playing out in the fact that hunger, even though it hasn't come down a lot, has remained stable. And we also see it in the fact that people report slightly higher levels of satisfaction with the types of food that they're able to consume. So overall, lower food inflation is showing some signs of improved food security, yes.
The stories that stay with me from the sort of worst part of that food inflation time tended to come from the Eastern Cape, and I don't want to go too much into it, but the idea of mothers who felt they couldn't feed their children. And I was reminded of that because it seems that the Eastern Cape is the one part of the country that did not improve in this period.
Yes, we observed this in the data. We observed that the food security situation has actually not improved significantly. In the other provinces, it has improved in the last year. And this is really concerning because it is a province with severe socioeconomic distress. It is still a province with high rates of unemployment, which is clearly a predictor of whether households can afford to buy food and afford to buy healthy food. And you mentioned mothers who want to give nutrition to their children. Crucially, mothers are often isolated from labor markets and from jobs and the types of incomes that are required to be able to provide the types of diets that children need.
How big an issue around the country is the issue around food variety? You don't want to, and I mean, I referred earlier to what I presume you will have confirmed, 24%, I think it is, of our children are still stunted. Often children will go to bed at night with some food in them, but often it'll be noodles increasingly, pap, I'm sure, not enough protein, not enough vegetables.
Yes, that's quite correct. So our stunting rates are quite high for our level of economic development, which is a concern, especially because it's enduring throughout the child's life course. It also influences how they can perform at school and eventually in the job market. And diet diversity is one important factor in this matter. It is important to be able to have a wide range of micronutrients, which only comes from consuming different food types. And in South Africa, according to a survey by the Human Sciences Researchers Council, about 20% of households consume far too little food variety. It doesn't go up much further than that. But the point is that how South Africans could consume more healthy foods, especially fresh fruits and vegetables, which are very important in this basket.
Professor Dieter von Funtel, thank you. Professor of Economics at the University of Stellenbosch. Andy du Plessis is the Managing Director of Food Forward SA. They supply food to charities around the country. Andy, good evening. Have you seen any changes to the scale of need for food? Has there been any reduction in the need at all?
Evening, Stephen, and thanks for having us. Absolutely not. There's not been a reduction. In fact, we are seeing an increase in food insecurity across South Africa. We've just commissioned the South African Labour and Development Research Unit at UCT to do a study and help us understand household food insecurity. And in the study, which we will release in the next month or so, it shows that household food insecurity has grown exponentially over the last 5 years. In fact, it's worse than the post-COVID, just after COVID. And stunting levels have also increased. It's now at 29% of our children under 5 years are stunted. So things have worsened over the last 5 to 7 years or so.
What do you think has led to that? Is it just sort of unemployment? Is it our sort of social problems coming to the fore after the pandemic?
I think it's a conflagration of a number of factors. The first is, I think, our post-COVID recovery has been slow and it has not been equal. Was the first thing. Then we were hit with floods and then with riots. And then, of course, an economic slump with high interest rates. We now see lower interest rates and we see food prices starting to stabilize, but they still off a very high base. So we are seeing that our manufacturers, our farmers, are still trying to recover and are still in a low economic environment, and consumers are not spending as everybody would hope. So things are quite slow at the moment, economically speaking.
Are there any obvious government interventions? And Andy, I know this almost inevitably ends in a conversation around a sort of basic income grant or social grants in some way. And the reason that social grants work is because they put money directly into the people who need to make the decisions to feed themselves.
Right. I think one of the problems is that, there are over 55 government programs focused on food insecurity across South Africa, but they are not integrated. There are huge amounts of gaps, and government is trying to do it on their own without cooperating and working with non-profit organizations like Food Forward SA. So there's a huge amount. We're talking about billions of rands that are being spent by government on healthcare programs, on social programs, but food is not reaching the people that need it. You'd have read last week in the news about food parcels in the Eastern Cape. 12 food parcels were distributed, costing something like 1.8 million rand for 12 food parcels.
Sure.
So those are the kind of things that firstly need to be addressed. And the second thing that needs to be looked at is, a lot of people are talking about a basic income grant, but I think one of the things that we need to start looking at is looking at food donation policies that reduce the huge amount of edible food that's going to landfills, and that's one of the ways that we can address the food insecurity and malnutrition crisis.
Andy du Plessis, always good to hear from you. Thank you. Managing Director of Food Forward SA. Just a reminder of the scale of the problem we face.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
5 minutes to 7. News from the Government Employee Pension Fund that some members will be told that their withdrawal benefits are being reduced. In other words, their statement indicates that they may have less money to withdraw. The GEPF says this is because that actuarial interest values have changed. Musa Mabasa is the Principal Executive Officer at the Government Employee Pension Fund. Musa, good evening and thanks for your time. Okay, why are people seeing that their withdrawal benefits are now lower?
Good evening, Stephen. So, as you've rightly introduced it, we apply actuarial interest factors to work out the present day value of a member's benefit before retirement. So once every 3 years, we conduct a statutory actuarial valuation, and from that valuation, we get actuarial interest factors. As indicated, these factors allow us to work out a member's retirement benefits today, before retirement. So if they resign, we're able to pay them the equivalent of what they would be earning at the fund during the time of resignation. If a member stays until retirement, these factors would not impact members. We've been doing this for many years, once every 3 years, when we conduct our actuarial valuation, and we apply the changes to the factors after consulting with labor organizations as required by the GEP law.
Okay. What are the factors then that would lead to someone's actual benefit being higher or lower? What changes, in other words, to change the value?
So what our actuaries do when they conduct the valuation is they make a set of assumptions. Firstly, a set of economic assumptions about how our investments will perform going into the future, and that is a science that only actuaries are able to work out. If we could predict the exact numbers, we would do so, but the assumptions are made about the economic performance of our investments, how much salaries will increase over the years, to work out what the economic potential of our financial circumstances will be in future. Secondly, demographic assumptions. So our actuaries will look at things such as when our members will retire, at what age, mortality rate of our members, ill health retirement, how many members may retire due to ill health, as well as early and normal retirement. So they use these assumptions to work out probabilities that help them estimate benefits at a point in time. So present value our members' benefits to today based on the promises made in the future.
Okay. Your investments, I presume, most of them are in the PIC, would have gone up in the last 3 years. What then has changed? I mean, what's the big factor that's made the average benefit 15% lower?
You are spot on. So because the actuaries, based on the assumptions and the projections, see that the rate of our growth in our investments will grow at a higher rate going into the future, it means we need to hold less benefits today to pay out what is promised at retirement. So that then means if you leave prematurely, what we should give you today, which is what we are holding on a member's behalf, will be lower than what we will need in future. So it's exactly as a result of the positive performance of our investments and the returns from our investments and how they actually see that going into the future, that they will be growing at a faster rate into the future. Therefore, we need to hold less money for our members so that they can get the promised retirement benefits at retirement.
Okay, that might sound then that because I've decided to retire early and I am a government employee, I am now being punished because the stock market's done so well.
So, Stephen, it's not necessarily punishment. So if you remember that
it's going to feel like it to me.
It appears so, but it's not the case. So GPF as a defined benefit scheme pays a defined benefit. And it's a simple calculation. We use your number of years of service times the final average salary over the last 2 years before retirement and a factor that we apply at retirement. So if you leave the fund much earlier than retirement, we have to work out the present day value of this promise. It's not what you've put in, but it's based on the formula from a defined benefit perspective. So it appears as though you're getting less, but it's your share of the benefits today when you prematurely leave the fund without retiring.
Okay. The fact that it's a defined benefit fund, I think, might mean to many people that I would certainly get what I'm due no matter what happens. That's kind of the point of it. But then the application of these factors shows that actually I'm getting less than what I expected.
So making a simple example, Stephen, to clarify this, if the GPF promises to give you, whether it's a house at retirement, and it's a certain type of house, the house will be given to you at retirement regardless of the performance of the investments at the time. If you leave prematurely, surely we can't give you a house as promised because you have not met the requirement, which is retirement. So we'll have to give you the equal value at the time of resignation when you exit before retirement, so that we don't prejudice those members who stay until retirement and get that guaranteed benefit. So if we pay members out now based on a higher interest factor, it means those that retire will then get less at retirement. So this is to ensure a level playing field for all members at exit.
Musa, thank you very much indeed. I think I get it now. Musa Mapase is the principal executive officer at the Government Employee Pension Fund. Who said pensions were simple? It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025. Siphumelele Zondi, your tech expert, we'll speak to him in just a moment. A lot going on around AI. I'm sure you've heard AI voices. Are they going to come from your call center job? It is a conversation uncomfortably close to home. Let me just sort of leave that there. Also, you would have seen the story, Standard Bank and their big survey, 80% of township businesses across most of our economic hubs are unregistered. No one better than Bulelani Balabala from the Township Entrepreneurs Agency to explain that and why that's happened. I made the point yesterday. I think if you register a business, you just get nothing for it. I think that's really the issue. It's just all pain and no gain. We'll put it to Bulelani, see what he has to say around that. And then in investment school tonight, this kind of strange duality. It's almost schizophrenic. You've got very high AI stock valuations. That presumably is people putting money into stocks they believe are going to increase in value. And at the same time, you've got people putting all the money they can into gold, which normally means people are expecting a crash. I mean, it's oversimplifying the situation, but they can't be both right. Obviously, you can be both right because you can put money into both. But we'll concentrate on that in investment school tonight, 7:10.
WhatsApp Stephen
on 072
702
1702.
Still voice notes coming through tonight about the conversation we had around the oil terminals in Durban, those Transnet terminals, and how the same companies are getting 25-year leases with no tender.
Evening, Steve. I think for me, more than anything, for the transformation to happen, the 25-year contract extension should include the empowerment within and diversification within, right? So if I've worked, call it at Engine, Astron, BP, whatever, and my aspiration is to actually to take over that in the next 25 years, that should be what the condition is, because it can't be an auto-renewal. It's probably a very specialized skill, so that's why it'll be a perpetual contract essentially. But I think, they need to look at what's the succession plan. That's the problem that we're having.
Yeah, thanks for that. And we heard the conversation from Andrew Pike about how the Central Energy Fund is a player. We are hoping to hear from the Minister herself, Barbara Creecy, on this. Was her decision. We are hoping that she'll speak to us tomorrow.
The Money Show, Tech Thursday.
If you had to think about which jobs are probably safe from AI, you'd think to yourself, well, being in a call center, person to person, maybe it'd be safe, but it seems not. We are seeing now that India is losing call center jobs. Spotify using AI in their new work with music labels. You can listen to their AI DJs if you want to. You won't want to do it for long. Google also talking about using AI tools in some of our languages. Siphumelele Zondi is our tech expert. Siphumelele, good evening. I mean, if I call my bank or whatever, I kind of expect to hear a human. I'm presuming now there are computers that can sound human.
Hello, Stephen. And yes, generally it's been humans up until this point, but that's all changing because you're finding that there are machines that you're starting to find on the other side. And I think sometimes even when they call you to clear out a few things or to sell a few things to you, you'll find that it's a machine that's calling you and not a human.
What we don't seem to have yet is that the voices that I hear are usually pre-recorded. In other words, if you say something and I'm the robot, I can't respond quickly enough to make it sound like a normal conversation. I mean, would that be right?
Totally. That is the case up until now, but it does seem like that there are generative AI initiatives where they are trying to make these voices to sound as human as possible. And that's the worry here, right? Because there are these new machines that are popping up that are starting to almost sound like humans, and they're almost starting, whether they are predicting what you're going to say next, or whether they are really registering what you are saying in order to find the relevant information for you. But it's starting to change.
We had big hopes for the call center industry in South Africa. It would seem almost immediately that that's suddenly under threat.
And not that long ago, too, right? Because you were hearing that the call center industry was picking up in South Africa, and there are pockets, like in certain pockets in Joburg, in Durban, and in Cape Town, where you're finding that a lot of call centers started to come up about 2 to 3 years ago. But it seems like that bubble is about to burst because India is already complaining about this because they have been the back-end industry of the world for a very long time, where especially the English-speaking world, when if you needed something, you'd find that it should be transferred to a call center over there. But there are now a lot of startup companies that are growing at a really rapid rate that are taking over that call center work using generative AI tools and developing and perfecting what those voices in those tools actually sound like.
You and I have had a conversation about AI in music. Now, Spotify say they want to use AI responsibly in the music industry. When I hear a big company say they want to use AI responsibly, Siphumelele, basically that means to help us make more money. What are they actually doing?
Well, what they've come under fire for their use of AI in a lot of ways, and also for allowing music that's been generated by AI on the platform. There's even been accusations against Spotify and possibly other music streaming platforms for pushing AI-generated music. And some in the music industry say this is believed to have been done so they wouldn't have to pay royalties to actual musicians who are coming up with new music. So that pushed AI-generated music. So in terms of ethics, they've come under a lot of fire. So they're now saying that they want to work with the music industry. And they've named a couple of big music groups worldwide that they want to work with. And they're saying this is because AI is advancing quickly, and so they want to start working with them on developing methods of using it ethically and to stamp out what they say could be the worst outcomes of generative AI in the music industry.
I presume this would be to help record music as well, to create new types of music maybe?
So they're saying they're developing a few tools that can be used by the music industry. They haven't quite said how the music industry can use these tools to its benefit, because up until now it's been said that it's to the benefit of Spotify and possibly other streaming platforms because of how they are pushing music, how music that's been utilized, and also how they can understand the consumer better. So it's been benefiting them as opposed to the music industry. But they haven't quite come out to say how it's going to benefit the music industry, but they're saying they want to work with the music industry and also to develop some of these tools that are going to help the music industry. And I suppose the musician as well in the end, because it's also been that worry that a lot of old music seems to be popular as opposed to new musicians, but that's because of the usage of AI, which picks up the older music that you probably listen to in your library and therefore pushes the older music as opposed to giving you new music and new musicians.
Sure. And in languages, Google says they're going to have AI bots that will speak properly in Zulu, Xhosa and Afrikaans.
Yes, they're working with a South African initiative called PanSouth. It's the Pan-South African language group that works with languages and development of languages. So what they're saying they're doing is essentially a pilot project. They also have mentioned Swahili elsewhere in Africa as well. So it's Zulu, Xhosa, Afrikaans in South Africa and Swahili elsewhere in Africa. And they're saying they are trying to develop some sort of AI glossary that can be used by Google and other people and other organizations, initiative people who are looking for, especially tech words and tech phrases, because you find that when we're talking about generative AI, I'm a Zulu speaker. There's no word for generative AI, and yet I can go onto the Zulu version of Google and type something in Zulu. It responds to me, but it probably can't find what generative AI is. And so what they're saying is that they want to work with PanSouth in order for them to develop some of this glossary of phrases that can be utilized in AI, as a lot of things are going the direction of AI from now on.
Siphumelele Zondi, thanks, our tech expert. Really do appreciate it.
The Money Show, Small Business Focus.
Bulelani Balabala is the founder of the Township Entrepreneurs Agency, joins us now. Bulelani, how's it? Good to see you. I'm sure you saw the Standard Bank survey and the study they did. 80% of businesses in township areas are not registered with government. And I made the point yesterday and I made it again earlier. It seems to me that for most businesses, you get nothing for being registered. I said I'd put it to you. Is that right?
Definitely. Definitely right. I had the opportunity to go through the paper. It's a partial representation because it only covers 5 very established townships or 6 very established townships in the country. And then I think obviously the headline in itself is misleading because when you pull out a sample pool of less than 300 and you make the assertion that 80% of those individuals, it doesn't give a true reflection. But also what it doesn't do is that it doesn't give the deep it takes away from the true issue. And the true issue really, when you really think about it, is the fact that there's a systematic approach to the conversation that says that systematically these businesses have been able to build sustainable businesses outside the constructs of a system that excluded them. So over time, then various institutions, whether financial or the sort, are now seeing this market as a potential one. And I think reporting on the ones that aren't registering as opposed to now working towards the how, which is why I've often said consistently that the approach that big business needs to take is one that says, in actual fact, as big business, we are the informal ones. When you go into the township market, you go in there with a sense of, Can they help us formalize ourselves and how the township economy then works? It changes the whole entire conversation totally. So I think the better befitting headline, or sort of thinking about it as I was driving here, is definitely not unregistered. Definitely not necessarily unregistered, but very organized. So the question is, why are they so organized? So that we build systems that support them or learn from these systems upstream.
I mean, it seems to me that there's this whole kind of argument and discussion going on about it. And yet none of it's resulting in any more economic activity. None of it's resulting in a situation where it's now easier for, I mean, I don't care, formal or informal, registered or unregistered. I mean, I'd like to hope that the smaller businesses are the ones that get the most help. I'm not seeing any of that.
No, definitely. I mean, I think that's my disposition as well, which is why, I mean, I lead with, I think what I closed off with just now to say, if our true endeavor is to support these enterprises and business owners, then the big winner must be the business owner at the end of the day in being able to make their lives a little bit easier. I mean, I'll make you an example. I mean, there's a sales gentleman I know very well, but also had the conversation of speaking to, who's now an entrepreneur, but worked in sales at the time at one of the dealership that was owned by Dr. Richard Mamponya at the time. So he then mentions that one of the things that actually got them or him and his department doing extremely well in sales is that they understood a couple of things. You've got this dealership in the 90s in the middle of Soweto. You're now trying to bring in financial tools, not necessarily financial tools, but bridging finance for these individuals to actually get finance and get these vehicles, but they don't have the paperwork in place. So they did a couple of basic, simple things. He would then walk the guys on a 3-month journey. So every single Friday, you will come in, we'll write on a ledger what you've transacted, how much you've made, and I will drive you to the nearest bank so that you deposit that money. So after 3 months, he was able to take that to the FNI, get them financing for those vehicles. And then guess what? The word spread because it's an individual who walks you through the journey. So oftentimes it's not necessarily that the individuals are reluctant or unwilling. It's the fact that even the institutions sometimes that are in place are not doing the deep and hand-holding work of bringing people along for the journey. It's almost we've hit the ceiling with the markets and the clients that we currently have. We see that there's this almost 3 million or 5 million individuals that are in the informal economy. Why can't they just register so that we do better? And I don't necessarily think that this position is the one. So I mean, think about it this way. For a small or micro business of any kind to register with CIPC, and there's no part of this conversation, I think, with the listeners where I advocate for non-compliance. I think compliance is an essential and critical and important thing. But the point I make here is, even before you make any money, you must still file your annual returns with SARS. For the fact that you've registered your business with CIPC, you file your annual returns at the end of each and every month. In most cases, there's a SARS help desk that you go in and you do that. That's money that you utilize to do that. Sometimes you need accountants. And then because based on the industry that you are in, if you're electrical, you might need to get a CIDB grading or NHBRC certification. That's an easy 1,000 Rand for the NHBRC and CIDB. So automatically the cost is almost 20,000 Rand for a fully compliant business with registrations with the industry body before they even make a cent. So I think for me, the bigger question or the bigger conversation is how do we build market access opportunities that make the guys easier for the guys to come along for the journey? My second example that I make to you is that about 4 years or 5 years ago, we worked with a banking institution and we wanted to roll out a campaign or a product that went out into various townships as a roadshow. And the part of that conversation, they said they will then bring in their already established relationship with the eventing guys and with furniture and all this stuff. We said, no, we won't do that. In actual fact, what we will do is we will ensure that we bring in the local guys. And then the big conversation is, will they deliver? Are you sure they can? Do they have the paperwork? And then we said, we will act as surety. Where they can't deliver, we will refund you back whatever they didn't deliver and make sure that we act as a buffer. You know what the beautiful thing about that is? A lady who's on the corner of the road in Mamelodi who bakes food and everyone in the community, who cooks food and everyone in the community knows that she actually is good at that. You are now able to take her, get her with an individual who's got a certificate of acceptability to act as compliance over the delivery of that food. And guess what? She's now incentivized to say, in actual fact, this is what growth looks like in opening up a different channel in a different market. I think for me, that is what shifting perspective and shifting perceptions then look like. So we are not then drawn to clickbait headlines, but we are drawn to what's supporting the end guy.
It seems to me that there's no kind of thinking in this way coming from government. It seems to me it's more of a, you must be registered, we must regulate you, and that's kind of it.
Yeah, I mean, And you know what? And I really, when I think about this, I mean, I think about the campaigns you might have seen years ago that were blasted everywhere, and print media was paid for, talking about, we are going on a massive campaign to register businesses and make sure that we hit 1 million or whatever their target was. But they weren't dealing with the root issue, which was, are we as government, because I think my firm view, and I stand to be corrected on this, is that my firm view is that government's key role, especially in this particular sector and space, is to create an enabling environment for entrepreneurs to grow, for the flow of money, for financial activities, and also for commerce. So if you are now doing the practical work of registering, whereas accountants do that, and you're not doing the enablement of the ecosystem activities, then you're missing the mark on what the actual issue is. And I think now that's an overactivity, but no impact at the end of the day. And I think for me, the biggest thing that we really need is government to create an enabling environment. And what you find is that the moment you start doing that, guess what? More corporates fall into place. More corporates want to actually support. More entrepreneurs bud, and more commerce happens. And then there's economic stimulation. So these conversations that we now have around 8 out of 10 no longer become conversations, because things start to happen and flow. Why? Because you have incentivized. And incentivization, ladies and gentlemen who are listening, it's not freebies. It's saying to a resilient entrepreneur who's built a sustainable business, continue to build it, but now there's a different sales stream or pipeline.
Yeah. I mean, in the end, and I mean, so many governments will say, oh, we're going to do this, we're going to do that. And in fact, helping small business seems to be the last thing on their minds. And that's a terrible thing to say, but it doesn't seem to be a major priority. Do you sense in the rest of society maybe a slight change in attitude?
I mean, I definitely do. I mean, I think back to the days when one would speak about wearing local, and then people in the crowd would look at you like you're a madman. What are you talking about? But today I can walk proudly up and down the road wearing a t-shirt written Tsepo, wearing shoes called Batu, wearing a t-shirt written Galaxy Boy, created by a young entrepreneur in Pretoria. So I really think I've started to now see a big market turn in people taking a sense of pride in building up their own billionaires that actually look like them, that they actually want to see successful, as opposed to the mindset that says that individual of a certain race, of a certain kind, don't want to see each other being successful. So there is that market adoption and market change. I think for me, the biggest clarion call, and I always shout this at the top of my lungs, is if you see a small business, whether you've got the money or not, and their product is amazing, take a picture of their product, put it on social media, tag them. Their client might be on your social media platform. If you've got the money, buy the product, talk about it, and ensure that you put it out there, because we have posted and we have consumed products where we've put them everywhere and we've got nothing out of it. So you find a young man, a lady at any school, at any community who's a South African who's doing extremely well, show them love, because they're building our local communities.
Bulelani Balabala, good to see you. Thanks so much. Really appreciate it. Founder of the Township Entrepreneurs Agency.
The Money Show.
Investment School.
24 minutes now to 8 the time. Good evening. You with the Money Show. Investment School tonight. We'll take on that conversation we had with Jan Goos a little bit earlier. So many different things going on. On one level, you look at what's happening with international markets, and particularly in the US, money still flooding there, and you think, well, this is a boom time. What that normally means is people move away, as I understand it, they move away from risk and they move towards where they're going to find value. And if you're buying AI stocks now, it's because you think they'll be worth more in the future, probably. But gold, which is where you go when you're scared, is at record highs. I almost want to say beyond record highs, but $4,200, $4,270 odd dollars right now. It is, and as you know, I've run out of words, but it has been extraordinary. So they can't both be right. Gary Boyson, director at Rand Swiss, or can they? Good evening.
Good evening. Yeah, I don't know if they... it's an interesting way to phrase it. Can they both be right? Because I think one of the big themes that we've seen this year is just a total destruction in the value of the dollar. And since we're measuring both of them in dollars, they both look pretty amazing. But it's actually, you got to take a step back and go, wait a minute, this is just a dollar that's fallen apart. So gold price looks fantastic. I mean, I say that, but I mean, sort of tongue in cheek, because if we look at the Rand gold price as well, I mean, the returns have been spectacular, and the Rand, has appreciated quite significantly against the dollar. But I think I saw a client put a trade through today on a Kruger Rand at 78,000 Rand for full coin, which is pretty staggering when you could have had them at about 43,000, 6-7 months ago. So the rally has been in Rand terms as well. I mean, The question, can they both rally? Absolutely. The idea that that gold is just the fear trade. I mean, that's exactly what, everyone gets taught, kind of investments 101. It's a great hedge. It's a hedge against inflation. It's a diversified asset class that's non-correlated. So, when stocks go down, it can go up. And that's right to an extent. But there's something called the love trade and the fear trade. So the fear trade is that traditional hedge, but the love trade really comes from more of, the fear trade is kind of dominated by the West, but in the East, it's the love trade, which is as you see rising incomes in the likes of India, for example, you actually see more demand coming through for gold as well. And it's actually as you see this rising wealth, there's suddenly greater demand, and it's got nothing to do with fear or anything like that. So there are more elements, I suppose, to the gold run that we've seen at the moment. A lot of people also point to all the central bank buying as we see like de-dollarization, across central banks trying to diversify their balance sheets. And that's been true for a while, certainly for not necessarily accelerating at the moment, but continuing. And I think a lot of it also, it becomes a self-fulfilling prophecy when you can't really value something. Gold is, I love what Simon Brown calls it, it's your shiny pet rock. Yes. It doesn't produce a dividend. It doesn't, pay you a coupon. It's just a shiny piece of metal that people end up putting in their safe, maybe use for a bit of jewelry, very little industrial application, but has the tenets of money, which is interesting, but,
Could the same dynamic be driving both things? So with AI, you have a fear of missing out, and gold's valuation is now at a point where you have a fear of missing out because the rally has been so strong. You just think, well, the value is going to be higher tomorrow, so I am going to buy it today.
And I think you see that in investment markets, quite often. And that's how bubbles are built as well.
Yes.
When you suddenly, all the stories are, I bought this and it went up and you're missing out. Of course, it becomes
cryptocurrencies 101.
It's human psychology, and it does happen. And, it's, I think from an institutional point of view, I remember talking about gold. It was probably $1,300, $1,400 an ounce, and I think it was a question on a show somewhere. And I said, well, it looks kind of attractive, gave the positives of gold. And everyone kind of like almost spat on me. Like, what are you talking about? This is not a real investment asset. You're kind of one of the tinfoil hat people. And now this is something that you engaging at a hedge fund conference. And they're saying this is an absolutely essential asset that you should have in your portfolios, and making all the positive case for gold. So even in the institutional space, it does become a self-fulfilling prophecy. And certainly from retail investors, which we engage with a lot. Gold goes up, they see the return, now they want in.
Yes.
And you almost got to kind of remind them that sometimes a contrarian approach is not the worst thing. The idea to make money is buy low, sell high.
Yes. Your questions tonight for Gary Boyson, the director at Rand Swiss Investment School this evening. 011-883-0702, 021-446-0567. And of course your voice notes, if you prefer that, on 072-702-1702. And of course, this is really all about the sort of idea of what is going to happen next or not. Gary, obviously we need to use the word diversification here, because I'm sure what people are doing is splitting some of their investments because both are going so high. That's actually a very rational thing to do until one of them stumbles.
Yeah, so diversification, they always say, diversification is one of those principles that gets taught also at all business schools. So it's appropriate for this show, the investment school, that we talk about diversification, of course. But remember, diversification, is a way, it's almost a free way of protecting money. And that's wonderful. But they also say, you diversify to protect, you concentrate to create. Famous hedge fund manager, his name escapes me now, he says, he likes to put all his eggs in one basket and then just watch that basket very, very closely.
Yes.
And that is a way that you can generate huge amount of return. But as you say, from probably a listener's perspective where, you're looking at your overall portfolio, diversification is generally a free lunch. It's generally something that is good. We kind of normally explain it to clients. You've got your kind of bread and butter money, and you've got your yacht money. You want to have a portion of your portfolio that is well diversified, that is protected from volatility, because it's the money that's going to get you through. It's your retirement funds, etc. But for the money that's your yacht money, that you're looking to really shoot the lights out, there's nothing wrong with concentrating, and I think that's important to understand as well. But at this stage, like you say, is AI in a bubble? Is gold in a bubble? It's very difficult to tell. We can give kind of like, what do they say? In the market, you have great valuation tools and terrible timing tools. And generally, markets can remain irrational longer than you can remain solvent as well. So I probably wouldn't be betting against the AI rally at this stage. Generally, when every news headline is saying it's a bubble, buy protection, that's the market climbing the wall of worry. That's kind of not when markets crash. It's when everyone is telling you this is a no-brainer, then you've got to start worrying about it. So maybe a little bit to go, but very difficult to tell.
An interesting comment you made about wall of worry, because my next question was going to be, can we talk ourselves into a crash? But you suggest actually a crash comes much more unexpectedly. Certainly the previous ones have.
Yeah, and I think that's it. When there's a lot of skepticism, generally that is when people have money on the sidelines and there's still more capital to deploy. And typically bull markets do climb a wall of worry. I remember, kind of recovering out of 2008, and every discussion was about, will it be a V-shaped recovery? And everyone's, no, it's going to be a W-shaped recovery. And you just don't believe the first tick up, and it's going to turn down again. And then, and by the time it's at record highs, then it's an obvious thing. It is just market sentiment. It's market psychology, at least. So, is there more to run? Like I said, if I could predict that, I wouldn't be on radio and I wouldn't be working anymore. But yeah, from our perspective, you look at the US earnings season that's coming out now. You look at, we're going to get a lot of the AI results, but the expectations are for significant revenue growth. We're going to see earnings starting to come through. And that does feel a little bit different from the .com period, where you were buying websites with a .com domain that had no revenue, no earnings, just an idea, and you were paying billions for them. This does seem a little bit different, just in the context of certainly some of the bigger stocks, the likes of, the Amazons or the Microsofts or the Nvidias for that matter. Nvidias are essentially selling the picks and shovels, but people are buying in like the GPUs, whether they're building infrastructure that will never be used or not, that remains to be seen. But at this stage, the money is real.
So the whole point really then is that money is going through these things, and that means that the valuations are actually correlated to reality.
Well, at the end of the day, a stock's valuation is 100% correlated to its earnings in the long term. And as you said at the beginning of the show, you're paying up for these earnings at this stage, expecting those earnings to materialize. Now, whether or not we're in a bubble depends on whether or not those earnings materialize. That's what it's going to come down to. So, yeah, at the moment, the earnings, if you look at, let's say, the revenue line on Nvidia, it's staggering. If you took that off and didn't, you just gave me the income statement, wouldn't tell me what the product was, you'd say this is a fantastic company. You can understand why investors are buying into it. It doesn't have to be the story around the company, and I think that's maybe kind of the point I'll make. It's different. It's why it feels a little bit different from the .com at this stage of the cycle, is because you can see the numbers coming through. Like that's the big difference. But of course, there's a wonderful chart. It's called the Gartner hype cycle. It's the technological trigger where something new happens and then it kind of goes up and eventually you end up in the trough of disillusionment. And I think that will come. There's no question. But when will it come? That will come when we establish whether or not the productivity advances from AI do materialize or not.
In a way, social media may be heading into that trough right now. Platinum, and we do need to talk about that. The comeback has been very strong. I went to go and look it up today. Platinum's highest ever level was around $2,290. It's now $1,711. And on the face of it, that would mean it would have much further to go than gold does right now, which is already long past previous records.
Yeah, so platinum's interesting because platinum is very different to gold in terms of
it's got a use.
Its application. So, and also I suppose the supply dynamics of platinum as well. But if I look at kind of the demand dynamics, around just under half of all platinum is used in autocatalytic converters. It's automotive industrial applications. If you look at the investment demand, so total platinum demand for 2025 is expected to be around 7,000, at least 7.6 million ounces. Of that, only 320,000 ounces are investment demand. So there's a huge scope for platinum to act as an investment vehicle. And I was listening to the CEO of Volterra speaking, and he's already saying that they are starting to see the excitement around platinum because it fulfills a lot of the functions of gold in terms of it's durable, it's valuable for a small size. I don't know how malleable platinum is compared to gold. I think that's the other one that they've got to look at. But there certainly is investment demand for platinum picking up. I mean, specifically, it comes historically out of Japan. So the demand side of the equation is very different in terms of platinum, and that can drive obviously platinum high if we see a big pickup in investments. Of course, if we move quickly away from the internal combustion engines towards fully, battery-powered electric vehicles, I mean, it's going to disrupt the industrial side of the market dramatically. But I think it's also the supply side of the equation that's crucial, that South Africa is absolutely key in global platinum markets. And, we're running a deficit for the third year in a row. So, that 7.6 million ounces that are being demanded, it's only expected that we're going to supply 6.9 million ounces this year. And of that, South Africa is going to supply, call it 3.9 million of those ounces. So it's a significant player in the market, and a lot of it is also recycling as well, because one of the things that I suppose people maybe don't appreciate is, with an autocatalytic converter, platinum is 100% recoverable from that. So when you scrap a car, you don't lose that platinum. You can recycle it and put it straight back into the next car as well. So a lot of it is recycled platinum, but yeah, it's an interesting position. Can platinum go higher? The market's been in deficit for a long time. I remember pulling my hair out going, but this market's in deficit. We should have higher platinum prices. But the market doesn't move. But it seems to have woken up. And certainly the JSE listed stocks are not complaining, because if you weren't in gold and platinum miners this year, you've really suffered. But if you have been, it's been a wonderful, wonderful ride.
A message from Dino on the WhatsApp line saying, please ask Gary if he thinks silver is still cheap at $52 as a non-correlated diversification investment with a long way to go. It only breached its 1980 $50 high last week. Silver's not one of those metals we talk about very often.
Silver's an interesting one. I actually had this question on a webinar last week, and I went, silver's difficult. So you look at the silver-gold ratio, and there's no question that over time there's been a big decoupling recently. So with the gold run that we've seen, silver has lagged, and there's an argument for silver to catch up in a big way. The difference, I suppose, and the difference I pointed out in the webinar was gold is being bought by central banks as a diversifying asset. Generally, central banks don't buy silver. And then I thought I'd better go look that up. So I did. It turns out that in the 19th century, silver was held extensively on central banks. 20th century, almost
called the bimetallic question.
Yeah, nobody held it, but for the first time, we're now seeing the Russian central bank and the Saudi Arabian central bank entering into the silver market. So that in itself is, for me, very interesting. But silver, looking at the precious metal run that we've had, and if you look at the devaluation of the dollar, I do feel that there is probably more upside in silver. Now, getting access to silver as an investor is a little bit more tricky. So you don't have a wonderful product like the Absa New Gold ETF. You've got to go into the ETN space, which obviously carries counterparty risk as well. And even if you're buying silver, as you said, $50 an ounce versus over $4,000 an ounce, you have to buy a lot more of it as well. And I think the shops sell them in, they're called monster boxes. You can buy these kind of big bricks of silver. So it's, if you're trying to get a proper investment exposure to it, it is a little bit more difficult, but plenty of ETNs and products that do give you exposure.
We're talking to Gary Boyson tonight, and of course he's Portfolio Manager and Director at Rand Swiss. Are we heading into a bubble? Are we in boom times? Do we need to just sit back and enjoy the ride? And maybe buy just a little bit of gold for fun. 011-883-0702, 021-446-0567, voice notes 210-702-1702, 9 minutes stay.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
The Money Show. Investment School.
7 minutes to 8 the time. Talking, of course, to Gary Boyson. We're talking about the situation we find ourselves in where we have record gold prices and record stock prices at the same time. Normally, you wouldn't do it in quite this way. Gary, one of the best episodes we've ever done of Investment School was about how to leave your emotion behind, right? To be as unemotional as possible. And these two emotions seem to be a sort of AI euphoria, I almost said exuberance, but that's a different era. And then a kind of gold fear, except, of course, I think there's quite a lot of FOMO around gold, so there's that too. Do we need to try and be very mindful of this at this moment, that we need to not feel any emotion, or not allow ourselves to allow emotion to dictate where we put our money?
Absolutely, but it's far easier to say than to do.
Yes,
so,
always.
It's really easy to say we should go to gym and eat less, but to actually do it is different. And I think it's generally is a sign that you're dealing with a sophisticated investor or an investor that is going to be successful over time, is when they can divorce themselves from those emotions. Where you go, when you go and look within your circle of competence and you find that certain security and you look at its cash flows and you say, this is a great investment and it's really cheap and no one is talking about it, to have the conviction to go out and buy that and then be able to sit on it for a good number of years without worrying that you've bought at the wrong price or that your thesis is wrong. That is a sign that you are probably going to be a very successful investor. And I mean, Warren, it's kind of the Buffett school of thinking. And if you think of, he often uses an example of a farm. You've got a farm, it produces eggs and milk and all sorts of things, and you bought it at a price and you were happy that at that price you could get this many eggs and this much output, but your neighbor keeps coming to you and shouting a price for your farm. And sometimes it's really high and sometimes it's really low. Does it really change the nature of the investment? So I think if you tend to focus on fundamentals and you focus on the actual investment case of why you're buying something, you're going and buying a flat and it's going to give you a rental. Are you happy with the rental income that you're receiving? Don't worry too much about what the price of the asset is. And if you focus on those kind of things when you're investing, you're not going to go wrong. When you're just investing because a price is high, that's where you need to be cautious. And that is something that, like I said, easy to say, more difficult to do.
Okay, so one metal, one AI stock to hold for the next year. And we've seen what the JSE has done this year. Just the whole index has been up, 30% or something since the start of the year. It would seem possible to think that your metal wouldn't be gold at this point.
Oh, that's a good question. So metal markets are generally pretty efficient as well. Yeah. So the fact that the gold price has run up, as much as it has, at the same time, like just taking price as the only factor is probably not the best idea.
Yeah.
So what is the best metal to buy? Everyone is very constructive on copper at the moment, but also if you're looking at buying into a metal, like a metal I don't see really as an investment necessarily, because all of its value is going to be generated purely from scarcity. So to go and buy some copper and hope it goes up, that's not a good investment. To go and buy a copper miner that is actually going to mine copper, produce economic value, pay you a dividend, and benefit if that metal price goes up, maybe a better prospect. Copper is definitely in favor, but at this stage with the level of momentum behind gold, and we were early investors, so we have dropped a couple of our gold miners from the portfolios just on profit taking, and they have moved up aggressively. But like I said, it's difficult to tell where the top of a run like this is. We still have interest rates coming down in the US. We're expecting another 25 basis point cut end of October, another one in December, and about a 50-50 chance of one in January. That should be supportive of metal prices. So if I have to hold it do I have to hold it for a whole year?
You have to hold it for a whole year.
A whole year. You see, years are getting shorter and shorter for me.
So, long time in investing.
Yeah, so whole year. Can the gold run go on for another year?
Wouldn't platinum surely be the one?
But platinum also, it's had an incredible run. And I think when you're looking at a metal and a commodity cycle, they're typically multi-year cycles anyway. So that's why I would tend to move more towards a momentum trade on that for a year, because commodity cycles can be 10, 20 years long. So to go and say, let's go and find a beaten up like base metal miner or, that would be more difficult. So I'll stick with gold. Let's see what happens. Let's see if it can hit the old $10,000 an ounce. We'll come back in a year and see how bad this call is. But I'll stick with it for now, because in the next year the fundamental case for gold is probably not going to change.
Yeah.
We've
geopolitics is there.
Geopolitics is there. The Trump administration will most likely still be a factor that we're dealing with. Inflation, with all the tariff changes that we've said, will still be a significant factor. At the moment, the Fed is absolutely focusing on the labor market, and even though they're above their inflation target, they're kind of almost ignoring it. All very, very positive for gold. So I'll stick with the momentum trade for now.
We've got 10 seconds. One AI stock, NVIDIA?
AMD.
Really?
AMD.
Why?
Yes. Better priced with I think more growth prospects, and the latest deal has kind of cemented it in the infrastructure. So Nvidia's run hard. I think AMD's got a little bit of catching up to do.
All right. Thanks very much indeed. Really do appreciate it. Gary Boyson's Portfolio Manager Director at Rand Swiss in Investment School tonight. Lots of very interesting conversations to just try and unpack how it's all playing out at the moment. And I'm not going to tell you what to do. I mean, as you can hear, I'm torn.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
U.S. markets turning negative tonight. The Dow Jones down nearly 0.25%. The Nasdaq flat, but down 0.02. The S&P 500 down 0.21 at the moment. Just an indication of how sort of fragile things are. Aubrey Masango, he is up next. We'll be back with you tomorrow for the Friday edition of The Money Show. Good evening. It's 8 o'clock.